While the financial media is freaking out about Trump's China tariffs, smart money is quietly flooding into three American industries that are about to explode. Whether these tariffs will hurt or benefit in long run, only time will tell, but on an immediate basis, there are sectors which are about to transform and boom. Since the tariff announcements began, market sectors have shown dramatic divergence, with these three American industries already outperforming the broader market. And this is just the beginning of what could become a massive wealth transfer event most investors are completely missing. For those wondering what tariffs actually are, they're basically taxes on imported products. When that new iPhone costs $100 more or your favorite sneakers jump in price, that's tariffs in action. But while consumers feel the pain, certain American companies are about to experience a golden age of profitability. The recent electronics exemptions announced on April 11th created massive confusion in the markets. But what most people missed was Commerce Secretary Lutnick's bombshell on April 13th that these exemptions are merely temporary until a specialized semiconductor strategy is implemented. Today, I'm exposing the three industries set to skyrocket from these massive tariffs. This analysis is based on verifiable information, including official White House policy statements, documented market movements, and established economic principles. By the end of this video, you'll understand exactly which industries are being reshaped by the new tariff structure and how to potentially capitalize on this once-in-a-decade policy shift before institutional investors catch on. Any shift in government policy looks unlikely as they want to get key sectors back to America and safeguard them. Let me break down exactly what's happening with these tariffs and why they're creating one of the biggest market opportunities I've seen in the past decade. On April 2nd, Trump announced sweeping tariffs on Chinese goods at 145%. Then on April 11th, the administration exempted electronics from these tariffs, only to have Commerce Secretary Lutnick clarify on April 13th that this is merely a temporary reprieve until specific semiconductor tariffs are implemented in a month or two. Right now, the market's Fear and Greed Index is showing extreme fear. This indicator combines 7 different market metrics to show investor sentiment, and it's currently at one of the lowest points we've seen in years. As Warren Buffett says, the time to be greedy is when others are fearful, and the market is terrified right now. These policy shifts have created extreme market volatility. The S&P 500 has experienced multiple significant daily swings as investors struggle to understand the implications. Trump's economic agenda in 2025 centers on 4 key pillars that are completely reshaping market sectors. Strategic tariff implementation, with China tariffs now at an unprecedented 245%. Domestic manufacturing incentives, including substantial tax credits for American production. Regulatory reform, dramatically reducing compliance burdens across multiple industries. Energy independence policies, aggressively expanding domestic production capabilities. When analyzing which businesses will thrive in this new environment, I use what I call the 4 Ps framework. Place. Is the business primarily based in America? Product. Does it make something that competes with imports? Price. Can it maintain better margins than foreign competitors? Promotion. Does it have strong marketing to capitalize on Made in America? Companies that score high on all 4 Ps are positioned to absolutely dominate in this new tariff environment. The first industry about to explode is American manufacturing, particularly companies producing goods that directly crush their Chinese competition with this new tariff advantage. The Industrial Select Sector SPDR Fund, which tracks major U.S. manufacturing companies, has been significantly outperforming the broader S&P 500 since the initial tariff announcement. This isn't coincidence, it's direct cause and effect. American manufacturers facing direct Chinese competition stand to benefit in 3 powerful ways. Pricing power. With Chinese competitors facing 245% tariffs, domestic manufacturers can compete more effectively on price while maintaining higher margins. Capacity utilization. Current U.S. manufacturing capacity utilization stands at 78.3% according to Federal Reserve data, with substantial room for profitable expansion. Supply chain advantage. Companies with primarily domestic supply chains avoid the tariff burden on inputs, creating a massive competitive advantage. Looking at individual companies within the manufacturing sector, steel producers like Nucor and industrial equipment manufacturers like Caterpillar are significantly outperforming the broader market, reflecting investor expectations of increased domestic production. For investors seeking exposure to this trend, the Industrial Select Sector SPDR Fund, XLI, provides diversified exposure across the manufacturing sector. For more concentrated exposure, the SPDR S&P Metals and Mining ETF, XME, offers more direct exposure to companies that stand to benefit most from reduced foreign competition. The second industry set to absolutely dominate is American energy, the lifeblood sector that's about to experience a golden age of expansion and profitability. The administration has made American energy independence a cornerstone policy through multiple executive actions, approving new drilling permits on federal lands, expediting pipeline and export facility approvals, rolling back regulations that restricted production, publicly supporting American energy over foreign imports. The market has responded decisively to these policy directions. The Energy Select Sector SPDR Fund has consistently outperformed the S&P 500 since the initial tariff announcements. According to the U.S. Energy Information Administration, American oil production reached record levels in 2023 at over 12.9 million barrels per day. Current policies suggest continued support for expanding this capacity, creating significant growth potential for domestic producers. What makes the energy sector particularly compelling right now is its valuation relative to historical norms and the broader market. The sector is trading at a price-to-earnings ratio far below its historical average and significantly below the current S&P 500 average. The third industry on the verge of a historic breakthrough is the semiconductor equipment sector, the kingmakers who build the machines that fabricate every single chip powering our entire digital world. When Commerce Secretary Lutnick stated that electronics exemptions are only temporary until a semiconductor-specific strategy is implemented, he signaled a major policy initiative specifically targeting this critical industry. Every smartphone, laptop, car, and home appliance you use depends on these semiconductor chips. The industry that makes the machines that produce these chips is positioned for explosive growth as manufacturing reshores to America. The strategic importance of this cannot be overstated. The U.S. share of global semiconductor manufacturing capacity has collapsed from 37% in 1990 to just 12% today, according to Semiconductor Industry Association data. This creates both national security vulnerabilities and economic dependencies that the administration appears determined to address. The semiconductor ecosystem consists of three main segments, each with different exposure to potential policy changes. Chip design: U.S. companies like NVIDIA, AMD, and Qualcomm design cutting-edge chips. Manufacturing equipment: companies that make the machines used to produce semiconductors. Fabrication: the actual manufacturing of chips, where the U.S. has lost significant market share. What makes semiconductor equipment manufacturers especially interesting is their unique position in the supply chain. These companies benefit regardless of which chip designer wins market share, as all semiconductor manufacturing requires their equipment. For investors considering exposure to this sector, broad semiconductor ETFs, like the VanEck Semiconductor ETF and iShares Semiconductor ETF, provide diversified exposure across the ecosystem, including these equipment manufacturers. Now let's discuss how to potentially capitalize on these industry trends without taking on excessive risk. I recommend a three-tier approach to positioning for these opportunities. Tier 1, core position, 50 to 60% of allocation. Broad sector ETFs that provide diversified exposure. Examples: XLE, SMH. Lower risk, moderate growth potential. This foundation provides exposure to the overall trends while managing volatility through diversification. Tier 2, targeted exposure, 30 to 40% of allocation. More specialized ETFs focused on high potential subsectors. Examples: XOP, oil producers; XME, metals and mining; SOXX, semiconductors. Moderate risk, higher growth potential. Tier 3, individual companies, 10 to 20% of allocation. Selected companies with strong fundamentals positioned to benefit from policy changes. Examples from each industry we've discussed. Higher risk, highest growth potential. Instead of investing all at once, consider dollar cost averaging, investing fixed amounts at regular intervals. This strategy reduces the risk of bad timing while still allowing you to capitalize on lower prices during market volatility. 3 key catalysts to watch in the coming weeks: the semiconductor-specific strategy announcement expected in the next 30 to 60 days. Quarter 2 earnings reports beginning in July, which will provide insights into initial tariff impacts. Additional policy clarifications that could accelerate these sector trends. History shows us that major policy shifts like these create enormous wealth transfer opportunities. During previous periods of significant trade policy changes, investors who positioned early in domestic manufacturers saw returns of 2 to 3 times their investment over the following years. Which of these 3 sectors do you find most compelling? Leave a comment below with your thoughts and any questions you might have. If you found this analysis valuable, hit the like button and subscribe for regular updates on how policy shifts are creating market opportunities. This is Wealth Leverage Lab, where we transform policy insights into investment intelligence.